US shares break, US government debt rockets. What's next? Hi, everyone, and welcome to another episode of Insights brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, welcome back, Sam. And last week, he was giving us some warnings about what potentially was just over the horizon. Looks like that's what's unfolded pretty much to the letter. How are you going today, Sam?
Good, Chris. Nice to see you.
Yeah, I think you pretty much nailed it last week. You were showing us that chart of the one-year trend line on the S&P 500 and warning that it could potentially break. And how's that played out?
That's exactly what happened. We're looking at the situation, in the credit market worsening and pretty much a free fall towards this trend line. And it did test it. So it had a third test, but it did end up breaking. We just got that close the other day underneath this year-long trend line.
And you sort of warned about that last time, saying that you really do have to watch that quite carefully, because if it breaks that, it changes what the expectations are going forward, doesn't it? Like that's really what you were saying with that trend line.
Yes, you can't you can't talk your way out of a chart, really. I mean, there are some patterns which, like this doesn't, for instance, guarantee that the S&P 500 has to go down or that it has to go down in a certain time frame, like today, for example. But what it does show is that it's not a positive sign. It's not just like a news article. You can put spin on a story and say everything will be fine, it's about to recover. You can clearly see something's changed in the last year because it's broken below, and it's a textbook reversal pattern. So it's very hard to argue against and very hard to make the situation look better. And all the news is coming out saying that there's a relief rally. There's been a run up. One said that there's a race higher in the US stock market, and another one's saying there's a recovery happening. If you look at the previous day's candle, it didn't even rise to that level. So I don't know what they're talking about. A little green candle stretching halfway back up, essentially part of a free fall. And not one of those articles mentioned this break of a year-long support level, which is terrible.
I thought that was really well pointed out in the article that you'd written, because exactly that point, everyone's looking for the slightest bit of green and missing the big picture of what's actually happened there. So very important, I thought. You were also talking about the worsening credit situation for consumers. This is something that's difficult to put a positive spin on as well. Like they can do it with the market saying we saw that little bit of green, but this doesn't look particularly good at all. And you've got people not having the capacity to spend, and that seems to be not an easy fix, I wouldn't imagine. What have the updates been around that this last week?
That's it. If someone doesn't have the capacity to spend, we're looking at the consumer, not the government. So, I mean, the government can always pull money from somewhere, the consumer, their tax money or their their future. But a consumer, they're not just, if they're in so much credit card debt, they're maxed out and they can't spend anymore. Well, they can't spend anymore. That's it. There's no shortcut. And updates on that is a city just came out with some data from 16 different subsectors that they track in the economy, and three major things. So the total spending in September was down minus 10.8%. And that was the fifth month in a row that spending had dropped. And that actually makes September the worst month of the year. So it's gotten a lot worse in terms of consumer spending, consumer credit.
And that's there'd be a bit of seasonality around that as well, I imagine, because a lot of things I've been reading talk about September and October as potentially being the months where a lot of these negative data does come out, and we really start to see it impacting on the economy. Is that sort of consistent with what you've seen?
Yes, but then there's also leaning on seasonality to to try to fight the macro trend, which is happening, which is what you can see on the chart.
Right. So that's how you get that sort of push and pull, I suppose, that really has had us really in those tight bands up until now, where it's starting to break.
Yeah. So it's looked surprisingly too good to be true for about a year, and now it's things are starting to crumble. Yet all the news stories this morning seem to be very positive.
Yeah. Okay. So do you think, putting that sort of background together, do you think that this lowered consumer spending can finally allow the stock market, that is, to have that really deep correction that that we've been looking for? As you said, there's a lot of spin pushing it the other way, but is this the catalyst that can allow that to really flush out the system?
It could, and it would be to the consumer's detriment. It would be to investors' detriment who are, for example, buying in at a higher price because they think it's a bull market, and
Yeah.
yet things could collapse, and then they would have to actually sell out because they wouldn't have any credit, and then the big players can swoop in and grab things up for pennies on the dollar and ride them back up for the next cycle. So that's one possibility. The other possibility is, everything's fine, or something saves the markets and they keep going up. A new hot narrative comes out besides AI or some other development. But look, besides the consumer spending, that's a drop in the water, because you have to look at what the government's been doing, and they've been on a spending spree. Recently, in one day, the government's spent $275 billion.
That's a mind-blowingly large number.
So just to put that in perspective, if you look at the last couple of weeks, about $500 billion have been spent. Now, considering, remember back when the national debt was 10 trillion, now it's 33 trillion. Just think about that. That means if it keeps going as it is, not even if it accelerates, which debt usually gets worse and worse, as we've seen, because you have to print more money to make more of a difference. But even if it stays as it is right now, we're looking at adding about $1 trillion a year. So,
well, $1 trillion a year of new debt.
A month. Sorry, $1 trillion a month. We're looking at.
Well, I was just about to say $1 trillion a year. It looks like we're going to get there in about 2 days at the current rate of spending. That's just like absolutely insane numbers. Clearly, we can't have $12 trillion of debt per annum piled on, right? Surely that's not possible.
So we'll double it in a few years on this track, unless something changes. But what could change?
It's a real problem, and it's something that we keep talking about. We keep coming back to it. The numbers don't add up, right? The basic maths of this does not add up, because you just highlighted the point there. We end up double in a couple of years, and then that is that exponential explosion. That's that death spiral of debt, or the doom loop, or however you want to think about it. But how do you put this together? Because it looks like there's really only one way out. It's not actually a solution to the problem, but a way out of the short-term issues may be that they do come in with those rate cuts, create more money. We end up back in a quantitative easing. I've heard new terms bandied around like quantitative support, which will be the same thing with just a different letter on the end to try and confuse us all. What do you think they're going to do? Will they do it in time? Like how do you see this playing out?
I don't think they'll do it in time. I think it's probably already too late to do it in time, meaning to keep things from dipping, at least on the charts, which is actually the currency devaluing. It's not really the stock market going up.
Such an important distinction as well, isn't it? That's what's really going on. It can look like one thing, but it's actually something else.
Yes, and then when they do start, there's also the diminishing returns we talked about. So, for example, if you're throwing a bucket of water in the bathtub, it's a big change. But when you keep throwing buckets of water, eventually you're throwing buckets of water in a swimming pool and then in an ocean, and then you can't create enough money to make a big impact. We're talking about the debt, for example, so many trillions. The problem just gets bigger and bigger, and the stimulus has to be bigger and bigger as well. So you also think about the logistics. There's talk about digital currencies, central bank digital currencies, which would mean people can't take money out of their bank. They can't exit the financial system. Also talk about, everyone just gets an income from the government for free. And what all this looks like to me is just an excuse to go into panic mode and lock down the financial system, and then make sure we can keep printing money at a constant rate to essentially go into a constant state of quantitative easing, which would be a universal basic income, or all these different ideas people have as stimulus.
And it seems a little bit like you're being a bit alarmist, right? It seems like the things you're saying, that's a bit of doom. That's not really likely to happen, until you actually look at the fact we kind of already are in a state of constant quantitative easing and constant stimulus, because even though we might have just been through 12 months of really that reduction. That's 12 months in many years of it going in exactly the same direction. It really, it's not that big a leap, even though some of these things that you say seem a little bit, sort of Armageddon-ish in terms of the financial system. We're kind of there with a number of them already, aren't we?
Yes. Well, if you look at the chart of US debt, if you look at, the currency value, it's just going one way. I mean, there are little bounces, but it's essentially going one way. And what's everyone talking about? They're talking about when will rates get cut, not if rates will get cut. They're talking about when. So that just means more creation of money, more creation of debt-based currency. And gold's had a dip currently, but we'll see what happens when, if people realize this trend line break is a big problem. And the money printer turns back on, so to speak, although it's already being created in mass digitally.
$500 billion a day is kind of already going, isn't it? Like when you think of it like that. And the gold point is a really interesting one, because you get those little dips, as we always expect. You get that dip when we start to get that bit of panic happening in the stock markets around the world. But I don't know if it's sustainable this time. Like it feels like the pennies might drop for a few more people, that what's really causing this is the debasement of the currency. So you need to be outside of that system.
Yes, the debased partially copper penny that we have today.
Very, very much so. And it is certainly just a partial, isn't it? There's not even a whole lot of copper in there anymore. All right. Well, Sam, thank you for digging into all of that today. It's an interesting time that we're living through at the moment, and it seems like it's escalating. The last couple of weeks when we've been talking about this stuff, it seems like the next week it's really gone quite a bit further. So I think we'll be keeping quite a close eye on it going forward. So thank you for that.
Thanks, Chris.
Thanks everyone for watching. Remember, reach out with any questions or comments on those social platforms. That's us for this week. We'll be back on Tuesday to discuss all things markets and metals, and we will probably have Alex on with us then. So until then, have a great rest of the day and a great weekend, everyone.